All right, let's dive in. So there's a new, highly focused fund that's just hit the market, and it has a laser focus on one thing, India's defense sector. But what's really going on inside the Mirae Asset India Defense ETF? We're going to peel back the layers of the official documents to figure out exactly what it is, how it works, and who it might be for.
So, here's the game plan. We'll kick things off with the basics of what this ETF even is, and then we'll look at how it actually invests your money. We'll cover who this is really built for, dig into the crucial risks involved, and finally, wrap up with the key details any investor would need to know. Let's jump right in.
All right, first things first, let's decode the basics. What in the world is this thing? Okay, so the company behind this is Mirae Asset Mutual Fund, and it's set up as an open-ended scheme. Now, that's important because it basically just means the fund can create new shares or buy back old ones whenever needed, which helps keep things liquid and trading smoothly.
It's an ETF, right? An exchange-traded fund. You know, the easiest way to think about this is like a shopping basket. Instead of going out and buying one single company's stock, you're buying a whole basket that holds a bunch of different stocks, and you can buy or sell that entire basket on the stock market just like that.
Okay, and this is a really important detail about its whole approach. This is a passive fund. It's not trying to be clever and pick winners or beat the market. Think of it like a self-driving car that's been programmed to follow a very, very specific route. And that route, that preset map, that's the stock market index it tracks. No detours, no shortcuts.
And this is the map it's following. The fund's official goal, its one and only job, is to deliver returns that pretty much copy the performance of the BSE India Defense Total Return Index. It's designed to go wherever that index goes, for better or for worse.
Okay, so that's the what. But what about the how? How does this thing actually tick? Let's pop the hood and take a look at the investment strategy.
So this is the rulebook it has to follow. The fund is pretty much all in on the stocks that make up that defense index. We're talking at least 95% of its money. A tiny little bit, maybe up to 5%, can be kept in things like cash just to handle day-to-day operations.
You know, the strategy here is about as straightforward as it gets. If a certain company makes up, say, 10% of the defense index, well, the fund's goal is to have 10% of its money in that exact same company. It's literally just trying to be a perfect copy.
But that begs a really important question, doesn't it? I mean, how good of a copy can it be? Is it possible to match the index perfectly, down to the last decimal point?
Well, that's where this thing called tracking error comes in. It's just a fancy term for the little gap, the wiggle room, between what the fund returns and what the index returns. And the fund says that usually they expect that gap to be less than 2% a year.
All right, we've got the what and the how down. So, who is this actually for? Who is the target audience here? Let's see what the official labeling says.
The document is crystal clear here. It says this fund is for people who are looking for two very specific things. First, they want returns that follow the defense index. And second, they want to be invested specifically in the companies that are in that index.
And of course, they include this warning, which is just non-negotiable for something this specialized. They're basically saying, hey, if you're not absolutely sure this is right for you, please talk to a financial advisor.
Now, we have to talk about the other side of the coin, risk. And to their credit, the fund's documents are super upfront about this, and it's a section you absolutely have to pay attention to. I mean, just look at this. The official riskometer is flashing bright red. It rates this fund as very high risk. And why is that? Well, it's because you're putting all your eggs in one single basket, the defense sector. If that one industry has a bad day or a bad year, well, the whole fund feels it. And just to hammer the point home, they state this in black and white: there is absolutely no guarantee you'll make money. It's a standard disclaimer, but a really important one to remember. So they break it down into a few key areas. You've got your general market ups and downs, the risk that the fund doesn't perfectly track the index, plus all the normal risks that come with owning stocks and trading them on an exchange. Okay, last but not least, let's get into the nuts and bolts, the practical stuff. If you were considering this, what are the key numbers and dates you'd need to know? So these are the important dates for what's called the new fund offer, or NFO. You can think of this as the grand opening. It's the initial window where you can subscribe to the fund before it starts trading freely on the stock exchange for everyone. This little table breaks down the essentials for us. During that initial offer, the minimum you can put in is 5,000 rupees. The fund's expenses will be up to 1% a year.
You'll be able to trade it on both the NSE and BSE, and importantly, there's no exit load, meaning no fee for selling your units.
So after that initial launch window closes, buying and selling this thing is pretty simple. For most of us, it works just like trading a regular stock. You just log into your brokerage account and buy or sell units like you would for any other company.
All right, so we've gone through the what, the how, the who for, the risks, and all the nitty-gritty details. So after all of that, what's the big takeaway here?
It all boils down to a single question you have to ask yourself. This is a very high-risk fund, one that's hyper-focused on just one piece of the economy. So the real question is, does that kind of concentrated, high-stakes investment truly fit in with your own long-term financial plan and what you're comfortable with?